Hey guys, welcome back to the channel. In this video we're going to be talking about the big stock market mistakes that you can make that will end up costing you an awful lot of money in the short term and the opportunity cost of the long term. This video is aimed at investing for beginners and for experienced investors alike. We can all end up in the trap that some of these mistakes are. It is completely possible for experienced investors to make these mistakes as well as beginners. If that sounds like something you're interested in, please smash that like button to support the channel and consider subscribing as well. Hey guys, welcome into the video. So the first mistake is falling in love with the company that you've invested in. So it might be the fact that this company has made you an awful lot of money in the past, or it's made you an awful lot of money now. But there has been a fundamental change in the company that is going to significantly affect its ability to produce a profit or bring back value to you. Now, you should not get emotionally attached to this company. You invested because of its fundamentals, and now its fundamentals have changed. So you should definitely, if that is the case, cash out your profit. Don't get emotional, don't get attached. You're here for one thing, and that is to make money. So if that is the case, ditch it, take your profits, and then maybe later on you could come back if there is some sort of improvement. Don't be afraid to take profits. The second point I want to make is that you need to understand, as Warren Buffett said, understand the company that you invest in. If you're invested in ETFs across the world, the SP 500, the Nasdaq, then that's fine. It's across a whole number of companies, your money is diversified. But when you investing in individual stocks, you need to know exactly the business model of that company, what it does to make money, and what its strategy is going forward, as well as all the fundamental analysis that you conduct. You need to understand it and really be in amongst it and know exactly how that business makes its cash and where its bread is buttered. Next point is fearing a stock market crash or a stock market dip. It is actually quite the opposite. Stock market crashes and dips offer the best buying opportunities that there is. Everything is essentially on a sale, and everything, especially in value companies, offers extra value to you as an investor. As long as you do your research and you pick the right companies that have been around for a very long time and are high quality, then you can pick these companies up at bargain basement prices, and that is exactly what you're looking to do as an investor. Just as I said, timing the stock market dip, that is a point. You can buy in then, but try not to time the market. Try not to time when a stock is down or when a stock is up. You sort of want to dollar cost average your way in, and then not try and time the very bottom of a dip. It's better to just buy on the way down and then buy on the way back up again, because you can easily miss the bottom and then it'll cost you the opportunity period. So what you want to do is invest on the way down, invest on the way back up, and if you catch the bottom on the way, then brilliant. But don't be afraid of buying when it's on its way down. You need to be careful that you don't keep chasing it all the way down, but eventually it is going to bottom out. Next up is lack of patience or moving your investments around and chopping and changing what you're invested in. This will cost you growth, and it will opportunity cost you as well, because as the other companies are growing, once you've sold out of it and you're moving off elsewhere, you will lose that growth. So chopping and changing is no good for investing. That is more a day trading side of things. If you're investing in a company, you're doing it for time, and a considerable period of time. You don't want to be trading it over the course of a couple of days. Don't expect to make mega money in a couple of days, because investing in growth or investing in dividends is not the style of investing for you. You need to be patient. It takes a long time to grow a business. Businesses don't just grow into multi-billion pound companies overnight. It takes a long time and a lot of hard work. Yes, some get there quicker than others, so you need to keep an eye on them and obviously pin them down. Do your research and pin them down, but just be patient. That is the key thing. Don't just sell your investment because after 2 months you haven't seen more than 10% growth or 5% growth. Next up is lack of portfolio diversity. Now, I don't just mean that in the number of stocks, I mean that in sectors as well. So you can have 10 or 15 different stocks, but if they're all in the same sector, then that your portfolio isn't really that diverse, because if something comes along and whacks the tech sector, for example, then the whole of that portfolio is going to get absolutely smashed in value, regardless of the companies that you have in it. Now, the tech sector is very robust, but it is not immune to stock market shocks and shudders. If you have just a few positions in your portfolio, 1 to 10, then you are open to an awful lot of risk should something happen to one of those companies or that sector. Preferably, in my opinion, a portfolio of at least 15 to 30 positions is ideal, spread out over different sectors and different companies and stocks. That seems to me, by what the research that I've done, is the ideal amount. There is an argument for going down to 10 stocks or 10 positions, and there's an argument for a few more than 30 as well. But that seems to be the good mean in the middle, 10 to 15 to 30 positions. Do not buy terrible stocks. I know that sounds stupidly easy, but do your research thoroughly. Don't start yield chasing because there's a 10% yield on a dividend stock, because that'll get you trapped in a dividend trap, and that'll be the end of that. So just don't rush. There's no rush to jump in. Quietly, confidently, search how to research a stock. I've got videos on this channel that you can watch to do that, and then take yourself up a position. There's no good buying a terrible company that's only going to devalue or make a loss over time and lose you money. The next thing I want to talk about is going all in on your investment. So by that I don't mean all in on one stock. I mean you've got, I don't know, a portfolio value of £10,000 and that's all your money in there. You've got no other than your emergency fund, which I'm assuming you guys have. You definitely should have an emergency fund before investing. This is money held in reserve in your portfolio, ready to take advantage of any dips or any crashes that materialise. If you're all in and have no cash reserve, then you can't take advantage of this, and you might have to sell one of your positions to try and leverage that to take advantage of a different dip. That's not what you want to do. Preferably, to me, I would say have at least 5% of your portfolio held in cash, so you can deploy that ready to take advantage of any significant drops in a share that you are very interested in. I would definitely dollar cost average most of the time if you're a monthly depositor, but also keep a little bit of money back each month ready to deploy in that situation when you can take advantage of a stock market crash for sure. Have a long-term outlook with your investing time horizon. You are buying stocks for next year, the next 5 years, the next decade, rather than next week or next month. You want to be looking well off into the future. Will this company bring me value in a couple of years' time? What will its value be in a couple of years' time? Not will it be up a couple of % by next week, because if that's the case, you're just going to end up selling it, and that's not the way we do investing. And last but not least, don't be a sheep and follow the crowd into hype stocks or penny stocks that are being touted by all sorts of YouTubers or all sorts of investing websites. You can easily get caught up in that hype and get your fingers burnt. If you want to do that and you want to take part in speculative growth plays and penny stock investing, absolutely fine. I do it myself, but I keep it separate to my dividend portfolio and my solid growth portfolio. Keep a part of your portfolio separate for speculative plays, of course, that is absolutely fine, but then keep the rest of it on track and what you're doing. Don't get involved in the hype plays that are just going to end up pumping and dumping, where you might buy too high on the way up and then get caught holding the bag on the way back down. If you do that, be very, very careful and try and exit before the peak. After you've made, have a strategy. After you've made a certain amount of money, just get out and don't try and be greedy. Of course, that is easier said than done, however. Thank you very much for watching this video today, guys. It's been an absolute pleasure to help you out and bring you all this information. If you could consider smashing the like button and consider subscribing again to my channel on your way out, that would be absolutely awesome. I'll see you in another investing episode. Catch you later.